The headline should say dovish Draghi delivers, right? I mean, he was becoming very hawkish in terms of actually unwinding QE and actually letting the balance sheet kind of not grow at this point. And then all of a sudden, he gave us a big whopper today, right? Effectively wanting to introduce this TLTRO. I mean, he's essentially saying we're going to provide support ad infinitum at this point. And so I thought it was pretty interesting during the press conference. He actually did say we didn't discuss QE, but I think they were discussing QE as well. I mean, all these programs that came together, it's just saying that, look, we're scared about what's going on in the Eurozone. And I think what he's signaling is not a global slowdown. He's worried about a recession in the Eurozone, and he's trying to get in front of it. Time will tell whether indeed these policies will get there. But that's why you're seeing really the rally in global yields today.
Bonds are, falling. Everything's, yields around the world, as we said, are going down. So how low are yields going to go? Not only, elsewhere, but what does it mean for the U.S.?
Well, I mean, we've been very correlated here in the U.S. to whatever happens in Germany. So this rally we saw in the fourth quarter in yields, and it really hasn't moved significantly this year. But that fourth quarter rally was really predicated on German 10-year bonds dropping significantly. And so we moved almost pari passu in lockstep with those. And so I think at this stage, what you found is the trading range, we had talked about it last year in early 18, that you got to break 260 or 262 was the technical number to get above. If you notice, that's really held. If you want to get into technicals, we threw it over a little bit towards the end of the year when there's a liquidity crunch. But effectively, that 260 level is still holding right now. So we're still in the camp. This 260 to 3 is what we're seeing for the time being. And it's going to take some much more significant negative news to get us below that. Even everything you guys have been discussing about the negativity out there, we're still roughly at 265 on the 10-year today.
Yeah.
Hey, Jeff, obviously today is the ECB. That's what we're talking about. And you mentioned negativity, but couldn't this all turn around really quickly? And by that, I mean, look, you've got France going through its own Occupy Wall Street. That at some point will fizzle out. Supposing you don't get auto tariffs from the U.S., Germany can get back on its feet. There's a few things that can come together here actually in pretty quick order. And Liz, you mentioned Brexit, or maybe it was Jenny. Maybe you don't have a crash landing there. There's a few things that could come together here, and we could be out of this pretty quickly. Don't you think?
Agreed. And so the things you mentioned, they're actually self-imposed, right?
Exactly.
We went to this
They're unnecessary.
Yeah, we had this huge fiscal stimulus, this huge tax cut, and then we decided, oh, by the way, we're going to throw tariffs on all these imports, right, and create a trade war. And that trade war has spilled over to Europe. They're more dependent on than we are here in the U.S., as you guys mentioned earlier. And so I think as you start to look at it, a lot of these things are self-created. Brexit is too, although that one's a little more difficult to solve. I think we'd all agree.
You were talking about bonds, earlier today, the way sort of some of the things that you're looking to play in the way that the market is acting.
I'm going to make a big pivot here, but just the mortgage market. I mean, you're from Doubleline, so we kind of have to talk about the mortgage market a little bit. Why haven't mortgages felt the pain that you would expect them to feel as we roll off the balance sheet? Why does there still seem to be some good opportunities?
Yeah, well, if you think about the agency mortgage market, which is what the Fed has been rolling off the balance sheet, in there, essentially what they're rolling off are the prepayment speeds. So it's not like they're out there actively selling securities in the market. So this is just a natural rollover in the marketplace. And again, there's the ability to absorb this capital because it is a high-quality asset, right? And the majority of it being guaranteed by the U.S. government. And so when you think about the mortgage market, it knew what was happening here. And again, it's been telegraphed. The same with the Treasury market. But the big difference that we've seen with rates in general is that no one knew about this fiscal stimulus was going to be on the magnitude it is. You look at the first 4 months and what the deficit was reported, we're running at an annualized rate of roughly $1.2 trillion at this stage. So that's in addition to the Fed's balance sheet, in addition to the needs of corporate America. It's in addition to the needs of the ECB. And so what you're having is this global supply of bonds that's going to come to the market. But the mortgage market, it trades off of rates at the end of the day. And there hasn't been this incremental flooding of the market. It's just been the refinance activity of the U.S. homeowner.